Personal finance is currently locked in a loud, polarizing debate. Should you throw every extra dollar at paying off your house early, or focus on splitting your cash into the stock market? To see which path actually wins, let's look at two homeowners, Jake and Marcus. Both start with the same house and the same income, but they have two very different plans for their spare money. Marcus decides to invest. He puts $500 a month into a brokerage account for 30 years. At a realistic 7% return after inflation and fees, his portfolio grows to $612,000. Combined with his paid-off home and accounting for capital gains tax, his after-tax net worth is approximately $951,000. Jake pays his house off first, reaching a zero balance in year 18. He then takes the money he used to spend on the mortgage and invests it for the remaining 12 years. At that same 7% return, his final net worth lands at roughly $930,000. The landslide victory the internet often promises investors is remarkably slim here. After 3 decades, the gap between Marcus and Jake is only $21,000, a difference of less than 2.5%. Historical volatility can flip this board instantly. If the market returns 5% instead of 7%, which has happened frequently in real economic cycles, Jake actually wins the simulation by nearly $100,000. At today's rates and average market returns, the math no longer offers a clear winner. For many homeowners, the right choice has become a coin flip. Let's look at what happens when these strategies hit a real-world crisis. At year 12, both Marcus and Jake lose their jobs and need $40,000 in cash immediately to stay afloat. Marcus handles this in days. He sells $40,000 worth of shares from his brokerage account, pays a small tax on the gains, and moves on. Jake has over $260,000 in home equity, but he is completely cash poor. He can't spend equity to buy groceries or pay a medical bill. He has to borrow it back from the bank through a HELOC. This is where the plan frays. Jake faces a 4 to 6 week approval process, 9% interest rates, and thousands in closing costs. And because he's currently unemployed, the bank might simply deny his application entirely. This is the silent killer of aggressive prepayment. Equity is locked wealth, not liquid cash. A mortgage that's on track to be paid off early doesn't help you if you can't write a check today. The outcome of this debate is dictated by one specific number: your mortgage interest rate. At a 7% rate or higher, paying down debt is a guaranteed 7% return. Most market portfolios struggle to clear that bar after taxes and risk. But with a 3% mortgage, the spread against market returns is so wide, investing is the clear mathematical winner. The strategy of investing the difference is no longer the single correct answer for every homeowner. Its validity depends entirely on the rate of the debt it's competing against. Picking a team on social media is a financial trap. Instead, follow a specific, rate-agnostic order of operations to build your wealth. Step 1 is capturing your employer 401k match. That's a 100% guaranteed return on day 1, beating any mortgage payoff or individual stock. Step 2 is funding a Roth IRA. This provides tax-free growth and gives you the flexibility to withdraw original contributions in an emergency without penalty. Step 3 is building an emergency fund with 3 to 6 months of expenses in a high-yield savings account. This prevents having to borrow against home equity when things go wrong. Step 4, decide what to do with extra cash based on your mortgage rate. Under 5%, invest. Over 7%, prepay. In the 5% to 7% middle ground, split the difference. Half toward the mortgage, half invested. You capture both guaranteed returns and market growth. Wealth isn't built by following rigid advice from a previous decade. It is built by running your own numbers against the rate. Meet Jake and Marcus. They're 35, they earn the same salary, and they've each just purchased the same $400,000 house. After their monthly bills are paid, they both have exactly $500 extra to put to work. Jake allocates his extra $500 directly toward his mortgage principal. He wants to eliminate the bank's claim on his home quickly. Marcus pays the minimum on his mortgage and puts his extra $500 into an S&P 500 index fund, banking on long-term compound growth. Traditional financial advice favors Marcus, labeling early debt payoff as a mathematical mistake that leaves money on the table. But that advice was largely codified in 2021, a year when a 30-year mortgage cost around 3%. By 2026, the average mortgage rate shifted to 6.5%. Most of the personal finance world has failed to update the math to reflect this new baseline. When borrowing costs double, the old strategy breaks. We're going to run the numbers under these current rates to see what actually happens to their wealth over the next 30 years. The spread is the difference between borrowing costs and investment returns. A 3% mortgage and 10% return gives a massive 7-point advantage to investing. But today, a 6.5% mortgage and a 7% after-tax return means that spread has evaporated to under 0.5%. Because that wide margin no longer exists, the always invest the difference mandate is no longer a mathematical certainty. By year 5, Jake's strategy wipes out roughly $38,000 in future interest payments. That's money that will never leave his pocket. Each extra payment Jake makes provides a guaranteed, tax-free return of 6.5%.
In today's market, that risk-free return is highly competitive compared to high-yield savings accounts or volatile index funds. Marcus sees his portfolio reach $40,000, but he's also dealing with the reality of market volatility. He's watched his balance drop 15% in a single year, while his mortgage interest accrues every month. In a high-rate environment, the certainty of debt reduction provides a financial stability that the stock market cannot match during its down years. Jake's approach does have a significant drawback: illiquidity. His wealth is locked inside the walls of his house. If an emergency happens, he can't easily spend his home equity. To access that cash, he would need to borrow it back at rates that now exceed 8%. Marcus faces different friction. When he eventually sells his investments, he faces a 15% federal capital gains tax on all his growth. He also faces behavioral risk. Historically, the average investor underperforms the market because they sell during a panic. Jake's mortgage payoff, meanwhile, is immune to his emotions. Real wealth isn't just a gross number on a statement. It's measured by how much of that money you actually get to keep and how quickly you can access it. At year 10, the scoreboard shows Marcus in the lead with a net worth of $257,000. Jake trails slightly at $250,000. But this lead is deceptive. If Marcus needs to spend that money, he must first pay his embedded capital gains tax, which immediately lowers his real-world value. Jake's home equity has no tax bill attached. His $250,000 is a stable figure with zero liquidation friction. Once you factor in the cost of accessing the cash, the gap between the two strategies effectively disappears. At year 18, Jake reaches the milestone Marcus is years away from. His mortgage is gone. His house is now a fully paid-off asset. Marcus still faces 12 more years of mandatory bank payments. He remains exposed to a recession, while his largest expense is due every month. Jake now takes his original $500 plus his $2,200 mortgage payment and directs it all into investments. He is deploying over $2,500 every single month. Jake's late start brokerage balance begins to rival the portfolio Marcus has been building for decades. By the end of 30 years, Jake has narrowed the gap to a margin that would have been impossible if his mortgage rate were still 3%. In a high-rate economy, prioritizing a mortgage payoff builds a risk-free foundation and provides the cash flow for a late-stage investment surge. Following the old rules without checking them